Is the property market going to crash? Today, we're going to look at a bank's Bleak prediction. We're also going to look at data and see what's going to happen and the predictions for areas such as Sydney, Melbourne, Brisbane, Adelaide, Perth, as well as Hobart. So we're going to dive into all the nitty gritty and understand what's actually going on. But let's have a look at it from the top and see what's actually happening. We can see that there's a bank's Bleak prediction into the housing market as to potentially an 18% fall that will result in the next 12 to 24 months. Property prices in Australia's two largest cities are expected to plunge an eye-watering 18% by the end of next year. Westpac, which has recently come out with data and an insight report that they've released talking about their forecast into the Sydney and Melbourne market, which they see will soon suffer a massive decrease, with property values in New South Wales predicted to fall 10% this year and another 8% in 2023. They also predicted that Melbourne's going to fall by 8% this year and another 10% next year. This is pretty similar to the reports we've seen from both ANZ and CBA, who had similar sort of forecasting around that 18% is where they see the market further dropping. Interesting to see that Hobart is actually tipped to tank 14% over the next 18 months. Now, the author, who's a Westpac economist, Matthew Hussain, has warned that the situation is bleak and the housing downturn has begun to start this year, has actually accelerated a little bit faster and broadened in the last 3 months. And nationally, property prices are expected to fall 16% over the next 18 months. Well, let's have a look at the data and jump into the details and see what's going on. We'll have a look at inflation rates, we'll look at unemployment, then we're going to look at each of the individual cities, starting off from Sydney, then we'll go to Melbourne, Brisbane, Adelaide, and Perth, followed by Hobart, and give you a bit of a better understanding of what's everything looking like. And guys, if you like these videos, it'd mean the world to us if you can hit that like button or hit that subscribe button, and it'll keep you up to date with all the information that we've got coming out. So let's have a look and see what it looks like. We can see inflationary rates. So Westpac had predictions previously in February and then May of this year, where they predicted that inflationary rates might only peak around that 4%. Then they said, hang on a minute, maybe it's going to peak at 5%. Now they're suggesting that inflation will peak later this year in around that 7.8%. So Westpac's saying that we're forecasted to hit inflationary at the top band of 7.8%. We know the Reserve Bank wants to be in that target band of 3 to 2%. Now, they're saying we're going to peak and then it'll come back down in the next sort of 24 months. We can also see their interest rate prediction. They predicted it previously that the cash rate would get under 2%. So it was going to be about 1.75. We're currently at 1.85%. So we're well above that. Then they changed their prediction and said, no, we're going to hit 2.5. And now they're sort of saying we're going to hit 3.35%. And you can see here, they're predicting that that's going to hold off. They're going to hit that 3.35, sit there for a few months, and then we might see that the cash rate will come back down, similar to where we are today, or maybe a little bit higher in the 2.2s. Now, the Reserve Bank's neutral rate, which is where it's pretty much their just right zone, is expected to be around that 2.5%, where it balances out wage growth and inflationary pressures, and sees that we have a pretty even movement in property values and the economy by and whole. From a wages point of view, we've seen that the unemployment rate has dropped to an all-time low. Previously, Westpac had predicted that it wouldn't get as low as it is now. So we're in and around that 3 percentile. We're expected to get as low as in the high twos, and then that's going to come back up. And as we start to see unemployment rise, we're also expecting to see the real wage growth, forecasted to hit around that 4.5%, 5%, which will help, particularly as we've seen relatively stable wage growth with COVID that actually reduced quite a lot. And then with inflationary pressures, we're going to see that it's going to have a fairly big swing in the other direction. The other forecast that we've seen that Westpac's come out with, they've looked at where the house growth's going to be up until 2024. We can see Sydney, they're predicting 10% negative this year. with an 8% negative next year, and then followed by a 1% increase in 2024. This sort of reflects where the market is at now. So if we look at the monthly change for Sydney, down 2.2%. Melbourne, we can see that it is predicted some pretty crazy growth in 2021. Same with Sydney, 25%. Melbourne had 15% growth in 2021. That's going to go backwards. So all that growth we saw over the 12 months that have been behind us, that's going to go backwards. So an 8% decline this year with a 10% decline next year, followed by a 1% increase in 2024. We've seen Brisbane that's had some fabulous growth in 2021, 27%. That's going to be steady this year. So they're saying a 2% increase this year, and then maybe a slight reduction of 6% next year, followed by 3% growth. We're seeing Perth, once again, some pretty strong growth of 13%, and even in 2020, some strong growth of 7.3%. And that's looking pretty steady like Brisbane, 2% growth this year, negative 4% for 2023, and then onwards with growth in 2024. Adelaide looking very similar once again to Brisbane, where it had some strong growth in 2021. It's going to have some strong growth again in 2022, mainly due to, I guess, lack of supply and pretty strong demand. And then it to go backwards by 6%, same mirroring Brisbane really for 2023, and then a 3% increase. Hobart, that's probably the one that's coming off the boil the most, had massive growth, 28%. So pretty significant growth there. We're going to see a 6% reduction in 2022, and then growth of 8% in 2023, and then neutral in 2024. What we did know is, when we look at the past and some of the regulatory requirements that have been governed by APRA, the bank's prudential regulator, we know in 2015, there was a 10% investment cap limit. Effectively, what that meant was that the lenders weren't able to lend more than 10% of their book or 10% of the loans that they had as investors. So they weren't able to grow their book by more than 10%. So if they had 100 loans, they weren't able to increase it by more than 10 investor loans during that period. That had a massive effect because we found in that 2015 period, there are less incentives for people to get investment properties. And now we're seeing a knock-on effect all the way in 2022, where we're seeing a massive shortage in supply for rental properties. We're seeing rental crises where rental prices are increasing quite drastically. So we can see sometimes these macro prudential regulatory tools have some pretty large impacts down the track that it may be unintended. We also saw in 2017 where interest-only loans were limited and there was restrictions on high lend loans where you couldn't do interest-only or investors. Once again, disincentivizing investors to get in the market. We saw in 2018 that the growth limits that were put in place in 2015 were removed. What we did find is not many investors were keen to get back in the market in the last sort of 5 years that we've seen these, first the limitations, then the removals. We saw that the investors were a little bit timid to get back in the market. We saw that in interest-only loans, the limits were reduced and removed in 2019. And then in 2020, when COVID happened, the banks had to have capital buffers to rely on as they gave COVID repayment holidays. So we can see what's happened in the past. In 2022, there were plans to cap high lends and reduce people's debt to income ratios. That's actually looking likely to be shelved for now or put on pause because the market's starting to go backwards. So there's no regulatory requirements to slow down a market which is already slowing down on its own. It's important to understand these back end, the history and what we've seen here, because it gives us an idea when we start looking into the data on how that's affected the gains and declines and what that might do for the future. Now, looking at the main areas of declines, we can see in 2020, 2021 on this side here, the areas that had the most growth, so from 0 to 35% growth, and we can see Sydney and Melbourne property market probably had the lowest amount of growth by and large, so no more than sort of 15%, most in the 10 to 5% increase. But in 2022, the forecast is that they're going to see up to potentially 10% reductions in growth, which is a fairly large decrease in values in comparison to the rest of the other capital cities. So the Sydney unit and Melbourne unit market appears to be getting the brunt of these price swings. And certainly, as we can see, looking and starting off with the New South Wales market, we can see that there's been a significant change in consumer sentiment. We're seeing that the New South Wales housing market is now in the grasp of a significant correction phase. There's been a downturn of 30% in terms of the turnover. So the turnover is down 30% since the start of the year. And we've already seen that Sydney prices are down 7% and have started to dip regionally in a bunch of regional areas. And based on the sentiment indicators that Westpac use, it's likely that we're going to continue to see a weakening in the near term. Now, we're looking at whether it's time to buy and price expectations. This is adjusted to the Sydney market. And we can see from a time to buy, the New South Wales average at that 120 mark is well below, sitting in at about that 80 mark. We can see that consumers aren't really motivated to buy at the moment. There is a lot of doom and gloom out there. And price expectations, once again, the average sitting around that 125, we're at around that 100 points. So we can see people's price expectation is a lot lower, which means you have a disconnect between vendors that are looking to sell and maybe not quite motivated, and buyers that also aren't really keen to buy, but might buy if the price is really low. Now, when we look at sentiment versus turnover, we can see that these two are pretty strong correlation there. We can see the sentiment, coming down, and the turnover, as mentioned earlier, down 30%. Last month, hitting negative 2.5. So we can see the turnover is coming down quite quickly. And when we look at the dwelling prices, whether we're in a boom, robust, stable, or correction phase, we can see over the last 10 years, the Sydney market has really been in either a boom phase or a robust phase for a very large percentage of the time. Maybe 6 months in 2016, we moved into a stable phase. And then even over maybe a 24-month period from 18 to 2020, we saw a correctional phase. So over the last 10 years, the Sydney property market has had some fantastic growth and some fantastic outcomes for those that got into the market early, but it has become really difficult for first homeowners and those that were left behind and weren't in the market. And we can start to see we're no longer in a boom or a robust or even a stable phase. We're moving to a correctional phase. So the Sydney market is in a correctional phase there. And net migration. So I guess since COVID, we've seen a massive exodus, 23,000 per annum, leaving Sydney for greener pastures elsewhere, because there's actually no requirement to be in any location for a long period of time, or even for work purposes now, given you've got the flexibility in your workplace. Vacancy rates, this is an important one. We talked about investors before and how the caps and limits have an impact on vacancy rates, number of dwellings available. We can see here, last month vacancy rates were at that 2%, coming under the average. We see in other states their vacancy rates getting quite low. And as a result, what we find is there's going to be higher rental increases because the vacancy rate's so low. And we can see dwelling approvals averaging under just below the average there on a 30-year average. So that gives us a good understanding of the New South Wales market. Moving on to the Victoria market. So we can see that, with the Victorian housing market, it's firmly in a correctional mode, similar to New South Wales, and turnover has fallen about a third since the start of the year. And it was from already a very high starting point. So, the turnover was at a 14-year high. It is down a third. So we've got to keep that in mind, that it has come down, but, off a 14-year high, and that the prices are 4.5% off the peak and already starting to track lower for the month. And we're seeing regional areas tick over. Now, same thing here. When we look at the sentiment, time to buy is down, same as Sydney. We can see that's massively down from the average, and price expectations are quite low in comparison to the average. So we can see similar sort of trends as we've seen in Sydney here. Same thing again with the sentiment being low. So we're seeing the turnover reduce. And unlike Sydney, the Melbourne market has had a correctional phase previously. We saw that in 2018 coming through to 2020, whereby there was a deepening correction. Prices adjusted and went down by about that 10%. And we can see the Melbourne market over the last 10 years has had its peaks and troughs, definitely had a very good run from really 2013 up until 2018, where it started to correct, and then some peaks and troughs with COVID. They were particularly hit hard with the COVID lockdowns, having a big impact on the property market there, and rebounding quite quickly once things opened back up. But now we're definitely in a very much correctional phase. How deep that goes, as per Westpac's prediction, they're saying 8%, then 10%, and then potentially starting to stabilize out in the 2024. Same thing with vacancy rates. Vacancy rates are a little bit higher in Victoria. That's mainly due, we can see here, the building approvals are quite consistent and above averages, which gives that supply. And we're seeing that vacancy rate is coming down around that 4.4%. And we're pretty much seeing low vacancy rates across Australia. So that has an impact on the values of rents increasing. And very similar predicament that New South Wales is in. We're seeing net migration is down 29% per annum. And that's obviously having an impact on the demand side of things for property. And as we move on to Queensland. So Queensland, we're starting to see that the housing market has had a bit of an abrupt shift in gear, especially with, at the start of the year, we saw a vigorous boom and things were in full swing at the start of the year. And now we're starting to see a bit of a correctional phase take place. Now, the turnover isn't as low as, 30% that we saw, or 33% in New South Wales and Victoria. The turnover is only off by 10%. So it's down by 10% in Brisbane, which is slightly above the long running average. And the prices have started to swing as well. We've started to see the monthly gains averaging around 2% for the first 4 months of the year. That's down to 0.8% in July. And that we might actually start to see that coming down in August again. And sentiment has soured a little bit, and it's potentially pointing that we might see a furthering or a lowering of sorts in price values, but it's still very tight from a supply and demand side of things, which should balance things out and could potentially provide underlying support for prices and Westpac's forecast to hold a net gain of 2% for 2022, and then a relatively mild decline of 6% in 2023. We talked about Queensland's 2021 that had some massive growth there. So seeing a decline in 2023, I don't necessarily think that's a bad thing. We've got to remember, all these markets we've talked about, they've had some pretty ridiculous increases in values. For them to come down is going to hopefully present an opportunity for a lot of those home buyers that have been left behind, that can't get in the market and really priced out, that it potentially might present an opportunity. Same thing again, when we look at whether it's time to buy in the Queensland market, that shift is definitely down quite substantially. And we can see the price expectations is still pretty high. So, not as low as what we've seen in the last 2 states, but price expectations might come down in the coming months. And we're starting to see, the sentiment as one of the leading indicators as to how the turnover might be impacted. Turnover is still relatively strong and holding its own, but I guess we'll see how that turns things out. Now, the Brisbane market's still in a very much of a booming phase. We might be starting to decline, so we're in a declining phase. But if we look at the Queensland market over the last 10 years, we've been pretty stable between a robust or stable market with, at a very small point in time, a correctional phase. But that slow and steady growth isn't a bad thing. It's been great, especially for buyers and sellers that have been trying to get in the market, having anywhere upwards of 5 to 6% growth year on year. That just keeps it things ticking along. There's not going to be that fear of missing out that feeds into itself and becomes self-fulfilling, and then further along increases property values, and then never ending. We did see that obviously when COVID started, a massive peak, 20+% increase per annum. So that's starting to come off. And I think some of what drove that was really the migration. We had 45,000 net migration per annum at the moment. That's mainly from Sydney, New South Wales, Victoria, Melbourne. And we've got buyers coming into the market here in Brisbane and seeing properties 10 kilometers from the city under $1 million and thinking that's an absolute bargain. And that would have had a lot to do with a lot of the price growth, is because there's a lot more money that's come from interstate. They're cashed up, sold their properties, and seeing immense value in the Brisbane market for your location you can get. Once again, vacancy rates are at an all-time low in Brisbane. We can see it's at 0.5%. And that has a lot to do with the dwelling approval rates. Dwelling rates are down. And we also saw a lack of investors. So we didn't see a massive amount of investment activity since the APRA prudential changes. And that has a knock-on effect because there's less supply, which once again, demand stayed the same or increase, and the vacancy rates are low. It's going to push rental prices up and deliver a rental crisis. Moving on to Western Australia. So the Western Australian housing market continues to lack direction. The activity and prices are stalling rather than turning down, as we've seen in the major eastern seaboard states. But the turnover's held flat at a relatively firm level since 2020 at the start of this year. And the growth has slowed, but still remaining a little bit positive and ticking around that 2 to 3%. I don't think that's a bad thing. We talked about the Brisbane market ticking along over the last 10 years, having a 2 or 3% increase, that slowly but surely increasing steady by steady, instead of that rapid increase and then rapid decrease, the pendulum swinging from one end to the other end. I think that's probably not as great a desirable outcome as what a lot of home buyers want, because there's no stability there. It doesn't give confidence. When we look at the WA Consumer Index, time to buy, that is on a low, a 10-year low, seasonally adjusted. We're seeing pricing expectations relatively high compared to averages over the last 10 years, but we can start to see that, the time to buy and people's expectations of when they're looking to buy is starting to come off the boil. We're seeing the sentiment is coming down, which actually starts to see the turnover decrease. And when we look at Perth over the last 10 years, we can see it has been in a very much a correctional phase since 2014 up until really the end of when COVID started. So the Perth market being subdued. A lot of that was to do with the mining boom. They had massive increases in values over the years prior to it. And then the boom started to slow down. And we've seen a massive increase in the last sort of 24 months where it's gone back, to that 10, 15, 20% increases that we've seen previously. And we're starting to move in that stable phase. If it stays in that stable phase, I don't necessarily think that's a bad thing. Anywhere from that 5 to 3% growth year on year, sees that steady growth. Net migrations at that 6,000 per annum, not a massive amount of migration as Queensland have seen. Migration nonetheless. Those migrants are going to be looking for new dwellings, and we're seeing that the vacancy rates at a very low level, same like Queensland. Dwelling approvals on the low, well below average. Moving on to South Australia. South Australia is one of the only major states that is posting gains, albeit it's starting to slow some momentum at the moment. The boom in growth at the start of the year has been one of the outliers that we saw. If we have a look here at the annual change, we can see South Australia racking up 24%. Queensland not too far off it with some pretty fabulous gains, but we can see South Australia really bucked the trend from a value increase. They are starting to move into a correctional phase, but they do have some tight fundamentals and they're less stressed or stretched from an affordability point of view. So they might see a milder correction. Once again, similar sort of theme that we're getting here. We're seeing people's ability or want to buy, the timing to buy seasonally adjusted is low. We're seeing pricing expectations in around the average. We're seeing sentiment lower than what we've previously seen in the average. The turnover, interestingly, is staying pretty high. So we're seeing the turnover remain relatively stable. And once again, still in a boom phase. That might be coming off the cool a little bit. South Australia having really stuck within that stable range for a very long period of time over the last 10 years. Net migration sitting at that 1,000 mark, and vacancy low, similar to Western Australia and Queensland. So some interesting fundamentals there. We're starting to see, the South Australian market is starting to cool off, but nothing that's outrageous or unacceptable. Tasmania, they're probably similar to the New South Wales and Victorian, where the contraction is starting to deepening, and we're starting to see both turnover and prices come down. And for a long time, the Tasmanian housing market has wrestled with an acute supply shortage. They've had long price gains, and they're being stretched. Those that have properties are now being stretched from an affordability perspective, and it's very comparable to the Victorian and New South Wales predicament that they're in. We're starting to see declines of up to 6 to 8% respectively over the 2022-2023 year. And looking at the indexes, we're starting to see, time to buy index is low. The price expectations is set to come down, still relatively high compared to averages. Consumer sentiment's low. The turnover will potentially start to fall. And we can see from how the Hobart market is from a dwelling perspective, that's starting to come off the boil from a boom phase, moving to a robust, then potentially a stable and a correctional phase. The net migration sits at about 1,000 for Tasmania, and we can see vacancy rates are below average, approval rates sitting in around that average mark. So it gives us a good idea. Now, if you're looking to get in the market and you're not quite sure, there's an excellent tool that you can use, is CoreLogic's mapping data. This will actually help you look at a 3-month rolling change in values. So we're looking at Brisbane here, and depending the areas you're interested in, you can have a look. So for example, Chermside West, that's down on the last 3 months by 2.6%, but suburb over in Albany Creek's up 4.5%. So we know each suburb's going to be having different fundamentals, different supply demand requirements. And this map is excellent, especially if you're thinking of getting in the market. You can get a better understanding of what each suburb's doing. You can look at the price change over the 12 months. You can look at the median values, and you can do this for every state across Australia: Melbourne, Sydney, Perth, Adelaide, every state here. I'll put a link in the description below. Hopefully it'll help you out. And guys, if you have any questions, hit us up in the links and details below. Thanks very much for watching.